Good day and welcome to another lesson. Our lesson today will be based on something called fair value and liquidity void. Fair value. Fair value implies that the market has traded evenly from supply to demand and from demand to supply. Fair value applies when price has left and did not trade and give others a chance to enter price or trade price. This happens frequently and is the basis of how price is traded evenly. Fair value traded evenly. Here on this typical example is when price has tapped into fair value, meaning that as you can see here, here price left imbalances in the market, right? Where here sellers were in the market and buyers came into the market and they all had a fair share. The sellers that came in here in the market, they traded, right? And the buyers that came into the market, they also traded. Everybody had a fair of price between this range from this high to this low. Everybody traded evenly. The market gave everyone a fair chance to enter the market, and the suppliers of the market go gain the fair share of what the demanders of the market got. In layman's terms, I meant to say that the sellers in the market had an equal share of price as the same as the buyers in the market. Price was traded evenly from supply to demand. Liquidity void. This is also fair value, but it implies that the range when price has not yet filled the fair value and has not traded evenly to fill in the ranges. This is a clue for us to see that the market needs to fill in the range and close the gaps. Liquidity voids are fast and sometimes erratic in nature, meaning that they leave big spaces in the market for us to know that it is going to be filled afterwards. This is a typical example of a liquidity void in the market, where we can clearly see that the sellers that came into the market here after this order block, because this order block is the source of this movement, right? Meaning that the people that came in here, right, they had a positions like buyers and sellers at the same time, but the majority of the people that came in there were the sellers, right? For them to close their positions, who must close? The buyers, right? Imagine this. I'm here, right? I want to buy the market to the upside, right? If I took a buy here and the market is trading downwards, right? Meaning that when the market trades up to here, this is where I'm going to close break even, right? Sharp. So this is a liquidity void, meaning that we want price to fill this void, this whole void. I want this whole void. So price traded downwards, right? Sharp. Let's see the next slide. So here is an example where both sellers and buyers in the market traded evenly. From this point here to here, right? The sellers, they had a fair share of the market, and the buyers also came and had a fair share of the market, meaning that if someone took a buy at this position right here, right, he took a buy, he will close at break even, he will mitigate his losses at this point, right? But a seller will make profit on this sale, right? And a seller will make losses as the market goes up, right? Fine. Now, here is a liquidity void for who? The people that took sales in the market. They want to close at the break even at this point, right? Like this is the same thing but just bigger, so we can see what's happening, right? Now let's see what happened here. The price dropped And when it came to this point, it was traded evenly for who? This side, right? And it left what? A liquidity void as well. A fair value gap. We use a fair value gap for targeting price to draw to and for an entries. Oftentimes, price if oftentimes if price sold or bought before an order block, it is tapped into a fair value gap. A fair value gap, oftentimes you will see it more when you gain experience in terms of screen time and just time using this method, time using this strategy. This is a typical example of a fair value gap, you see, because here at the close of this up candle and the close of this other up candle, this space here is what we define as a fair value gap. This is what we define as a fair value gap. Yeah, okay, let's go to the chart, guys. Let's go to the chart. Right, I just want to show us this example, right? So to recap, right, we see that this market here, it traded erratic, man, to the downside, right? This was the liquidity void, I meant to say. This was the liquidity void. This was the liquidity void. You see, this was the liquidity void. This is when price traded and filled some of the liquidity void, but not all the way through, right? Right, and there it left another liquidity void, right? Now, as you can remember, this is our break of structure in line with the trend, right? In line with the downtrend, because we're still down. Price hasn't given us a position to change character. This is still a break of structure. I don't want to mix too much of this information. Okay, so what happened was, when we see here, what happened? Any clue? Well, remember the PowerPoint slide that we had what here? Liquidity void, right? We had a liquidity void here, right? And this point where price is now, price traded fairly for buyers and sellers. Price traded evenly for both buyers and sellers, right? We can argue to say that we would have our entry, somewhere here, even though this price point scooped to the downside, would fair to say that we had our entry down here. Let me do this. Let's just do a typical example of how we would actually go about having a trade. What's happening now? How we would go about having a trade, right? How we would go about having a trade. Say we see we have an order block here, right? and price broke structure, right? Price broke structure, right? Price broke structure, and we want to have a buy stop. No, I meant to say buy limit. Sorry, buy limit pending buy limit buy price at 1.20886, right? 1.20886, right? We want to have what? A buy limit. So let's just have a theoretical stop. I actually missed it, right? I think it's this candle. But let's just move. Okay. Theoretically, let's say our stop loss, we want to put it like somewhere down here, right? How many points is that? From here to here, it's about 60 points. Let's just see 60, you know, and from here to here, it's about 150, give or take, 150, give or take, you know, or is the, yeah, 150, give or take, right? This is our trade, right? Our trade idea. We have a buy limit, you know. So let's see. Fine, price didn't come there. So price didn't come and tap here, right? Give or take. Price is at 12152, 1252512. Have a buy limit with 1213. Let's see, 1213. So have a buy limit here, right? Give or take. Price tapped in. Yeah. So that entry, right, we traded to where? To fill in the liquidity void, right? And we had a what? A $6, let's say $7 profit, 70 pips, right? A 70 pip run. So price traded fairly there, right? That's our example, right, of price trading to fair value. Okay. Delete last. Okay. Now let me just close this, right? That's our trade right there. That's our trade. Let's continue the exercise. Look for fair value gaps, look for liquidity voids. Now at this point, we remember we still had this, right? I think we can remember on the last slide we had a fair value gap, right? this could be our entry when price failed to go to the order block, to tap into an order block. Yeah, let me do this one. Let me use this one. If you can clearly see, right, let me just drag this down. If you can clearly see the low of this up candle here and the high of this up candle here, in between here price moved erratic. Price moved like, without leaving just a gap, without leaving a void or something, without filling in anything. So this is our fair value gap. Our fair value gap, abbreviation FVG, fair value gap. Above a fair value gap, often we find an order block, an OB, an order block, an order block. Right? So price, I just want to take it back a bit. But let's continue. Not take it back a bit. Let's continue and see how it leaves voids. Because now, when it dropped like this, right, it left a liquidity void. It left a liquidity void. It left a liquidity void that we would love to see it fill in future. Often the time it doesn't feel right away, man. It won't feel right away. You don't feel it right away. And you know what the beauty of this, ne? Is that this now gives us a change of character. Come on, man, don't do this. Move now for me, man. Right. You know what? Let me just do this. Just right on top there. Chalk, change of character. Change this. Make it blue. Why do I say a change of character? Because this high was violated now. This specific high was violated. Right? Meaning that here is our point where we want to enter the market to the long side. Right? To the long side. Right? Let's have a pending again. Where 10886, 60 pip stop loss. Let's see from here to here to the OB. It's like 280 pips, right? Give or take 300 pips, right? Have a buy limit there. Let's see how it plays. Okay, see how it plays. Okay, what happened was we see that void partially got filled up to this specific area. That liquidity void got filled up to a specific area, right? And our trade got tapped in, right? Mind you, when the market took a buy here, left a liquidity void, right? Let me go back. This is also a liquidity void, right? This is also a liquidity void. doing our analysis, we could also see that we had, up candles. What we can say, they are order blocks, right? Order blocks. If you are a trader who mentally you can fade the market, meaning that you can take the opposite side of where the market is going. You can just uh, take a sell, man, take a sell, but knowing that you're going to exit at specific points. Exit at specific points. No, you see, you are here, see, okay, I have a give or take 70 pip stop loss, right? Give or take 70 pip stop loss. You see that, hey man, if I want to come to the liquidity void, give or take 100 pips, right? To close the void, 100 pips, right? But it's dangerous, man. This is dangerous. It's dangerous to fade the market, but we can make money either way. Can make money either way. You see, we are in the trade, right? We hit TP, took a sell, we hit TP, fine. But our objection, since we change character, we want to go by, we want to take it high, tapped in there. Now, since the market now, it printed for us new candles, so these candles, they form the liquidity void. They form the void. We want to see if the void will be filled, right? Price is moving, price is moving, price is moving. The beauty of price action. The beauty of price action. Mind you, this is a 4-hour chart. You can just go to a 1-hour chart just to see how beautiful this price plays out, giving us a break of structures, confirmations, giving us break of structures, giving us break of structures. You see, you see. Now, wait, let me pause. Don't want it to play further. You see how price closed a liquidity void. You see that void now, the one that I was telling you about that other time. It got filled, that void. This void, with this movement, it got filled up there. It got filled. You see. Now price left another liquidity void. It left another liquidity void. Price left another liquidity void. You see, price left another liquidity void. If you can recall, in the group chat, we had this as a setup for long, as a setup for us to buy to the upside, right? This, right? One, 2160. How many pips is stop loss? Say give or take 50 pips. Give or take 50 pips. Let's just say 60. Give or take. Then from here to maybe above this range, give or take 200 pips. Give or take 200 pips. You will take 200 pips. We have a buy limit there, right? Let's see, let's see, let's see, let's see, let's see, let's see, let's see. Price tapped into our order block, right? The liquidity void is filled, right? Now price is traded evenly between both buyers and sellers. See, now this bad boy here, he left the liquidity void. Now we want to see him trade to the upside. We want to see him trade to the upside. Boom. Yeah, guys, that's our example right there. That's our example right there. End of scene. I hope this was a very fruitful lesson in terms of seeing how price is traded evenly from buyers and sellers. And we can see that we made a $66 profit, you know. Let's go to our trades. Let's go to the statistics. We realized a profit of $66, right? This, mind you, is hindsight, meaning that the market played already. This is what I saw happen, and this is not an expected realistic. How can I put this? Just because I did it on a simulation, meaning that you won't do it all the time in real markets because elements of fear and greed go into play. So, but with practice, you will get it right. You know, this was an example of a liquidity void, fair valuation, and fair value gaps. So let's just recap. 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 We had liquidity voids, price traded evenly between both sellers and buyers. What do we call that? Fair value, right? Buyers and sellers gained a fair value in the market. Buyers and sellers gained a fair value in the market. Buyers and sellers gained a fair value. These sellers and these buyers gained a fair value in the market. That's how we trade the market. Actually, that's how the market trades itself. You know, it trades using fair valuation. I hope this was a very, very fruitful lesson. And if you have more information, be sure to contact me and ask me more questions further upon it.